Hello financial fans, welcome back to another stock analysis. Today we'll be covering Johnson Johnson stock ticker JNJ. Johnson Johnson is a globally renowned multinational corporation focused on healthcare products and pharmaceuticals. With a diverse portfolio, they develop and manufacture an extensive range of medical devices, consumer healthcare goods, and prescription drugs, catering to the needs of people worldwide. Their commitment to innovation and improving human health has made them a trusted name in the industry. The company is currently sitting at a market cap of $414 billion, and in 2022 they generated a revenue of $95 billion. And the dividend yield is currently sitting at 2.98%, and they're a dividend king with their 62 years of consecutive dividend increases. 56% of their revenue is generated through pharmaceutical, 27% through medical devices, and 17% through consumer. To determine our final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25%. That can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $19 billion in 2013 to over $25 billion in 2022. The average EBIT growth is 4%, which is no change in the margin of safety. The margin has also gone up over the years, going from 26.7% in 2013 to over 27% in 2022. The average margin growth is 0.53%, which is once again no change in the margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years, going from $2.64 a share in 2013 to $4.76 a share in 2023. The average dividend growth during this period is 6%, which is no change in the margin of safety. This, however, with a very high payout ratio sitting at 94.5%, indicating that their dividend might be in danger, awarding them with a 5% increase in the margin of safety. The final two metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for J&J, this is just under half a year. In this case, a 49% debt to EBITDA ratio, which gives them a 5% deduction in the margin of safety. The return on invested capital for J&J is sitting at a very nice 15%, indicating that the management is very effective at allocating capital, awarding with another 5% deduction in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Johnson Johnson. The first valuation model that we'll be using is the discounted cash flow model. I've imported free cash flow of Johnson Johnson going from 2013 to 2022. The average growth rate in their free cash flow annually during this period is almost 6%, now projecting a future growth in their free cash flow annually of 4% for the next 10 years. With this percentage will determine the future free cash flow for Johnson Johnson and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8%. This gives us a sum of free cash flow of $373.5 billion. And to get an equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $357 billion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $137.45, which is a 14% downside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of J&J going from 4 years ago to the current year. The average growth rate in their dividends during this period was again almost 6%, and I'm expecting a future growth rate in all of their dividends of 5.5%. I will once again be using a discount rate of 8% in this valuation, giving us a dividend discount model price per share of $200.87, which is a 25.65% upside from the current price. The next model that we'll be using is Graham's revised valuation formula. In this model, we'll take a look at the earnings per share that J&J is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. Looking at all of these metrics, we get a fair value of only $52.36, which is a 67.25% downside from the current price. The fourth model that we'll be using is the multiple valuation. In this model, we took a look at similar companies to J&J, looked at their stock price and their earnings per share. This way, we could determine the average PE multiple in the industry, which in this case is sitting at 23.7. All left to do to get our fair value then is to multiply by the earnings per share that J&J is generating, which is $4.76 a share, giving us a fair value of $112.81, which is a 29.43% downside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of J&J of the past 5 years, and on average it has been sitting at 2.35%, while the current yield is sitting at 2.98%, indicating that it's undervalued on this metric. Doing the same with the PE ratio, on average it has been sitting at 22.52, while the current PE ratio is sitting at 33.59, indicating that it's quite overvalued on this metric, giving us a fair value of this model of $155.05, which is a 3% downside from the current price. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, discount dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $131.71. On margin of safety, we've determined earlier, using a 25% standard margin of safety, deducting it by 5% for the debt to EBITDA, 5% for return on invested capital, and adding 5% for the payout ratio, leaving us with a 20% margin of safety. When we apply this margin of safety, we get a fair value of $105.37. And with the current price of $159.87, it's a downside of 34%, indicating that's currently a sell. It should be saying a sell here. Johnson Johnson stock valuation may have a significant downside when investing due to a couple of factors. Firstly, declining earnings per share can negatively impact the stock price. Due to weaker earnings per share in the last quarter, their PE ratio has gone up significantly. And secondly, the premiums added to the valuation of dividend kings can also impact J&J's stock. As a company that has consistently paid and increased dividends for many years, it falls into the category of dividend kings. However, when stocks in this category experience high demand, investors may be willing to pay a premium for them, driving up their valuation. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.